Why did my bonds go down when the Fed cut interest rates? I'm getting this question quite a bit, enough though to make it mean I need to address this. So I'm surprised by how many people don't get this, actually. Anyway, so what happens is the bond market hasn't gone down. I had an email from a guy yesterday. He said he's very disappointed. Nice guy, but I was perplexed by his email. He goes, he's very disappointed that his EDV fund, which I own, which is the Vanguard Long-Term Government Zero Coupon Bond Fund. Remember, the more volatility, the most volatile bonds are going to be the ones with the lowest coupons. And a zero coupon has the lowest coupon. All right, there is no coupon. It's zero coupon. Basically, you pay $65 for it today. In 15, 20, 30 years, it matures at 100. That's how zero coupons bond work. You don't get an interest payment. You just buy it at a discount. It matures at par value. So a zero coupon bond is going to be the most volatile, and a longer duration or maturity bond will be the most volatile as well. So if you take a zero coupon bond and you make it long duration, long maturity, that's going to be your most volatile bond that is out there. And you can see by EDV, it's got some massive downside years and some massive upside years. I think it had 2 years when it went above 50%, 1 year when it went above 40%. 2019 or 20, I think it was down like 40%. 2021 is down another 20%, something like that. I can't remember. But anyway, so I bought this bond fund ETF last May, thinking that the interest rates are going to come down without question. They're not going to freaking 20%. They went up so high, so fast. It was inevitable that the interest rates were going to come down. I don't know when, where, or how, but I said that's a good risk worth taking. In the interim, even if they don't go down, I'm still going to clock in. I could go speed zone here for the school zone. Even if they don't go down, the interest rates, I still am clocking in a 4.5% to 5% yield at that point. So I was pretty comfortable with that. So okay. So if I'm wrong and the interest rates stay flat or they go up, I won't make much on the gain in the share value, but I still make 4 and 5% government guaranteed income. I was like, I'll take that to the bank, 100%. Now, but I knew. I said at some point the interest rates are going to go down because a 5.25% Fed funds rate, that's just not going to sustain itself very long. You could just tell. And I might have been wrong, but it turns out I was right. So the Fed just reduced their Fed funds rate by 50 basis points. But what this guy said, he goes, it didn't go up. The fund did not go up. And I was told that if interest rates go down, the fund goes up. And I said, what are you talking about, dude? This fund has gone up. The interest rates have gone down 100 basis points. Yeah, basically 20% has the interest rates gone down since April of this year. And what has the fund done? It's gone up respectively 20%. So I was like, what are you talking about? The fund hasn't gone up. It's totally gone up. Went up 20% in the last 6 months. Because the interest rates went down. Now, the Fed did not cut interest rates, I might add. They didn't cut interest rates until, 2 days ago. So how did the interest rates go down? Because of demand. When the Fed talked in March of last year, they started making some sneezing that they're going to start reducing interest rates probably. So what did people do smartly? Is they said, well, let me jump into some bonds, man, because if the Fed does cut, the interest rates go down, the price of bonds will go up. Everyone knows this. Investment 101. They didn't wait for the Fed to actually cut. They said, the Fed's probably going to cut, so this is a good speculative investment. And when I say speculative, I'm not talking about gambling. I'm talking about speculation in terms of it makes sense to reposition my portfolio to take advantage of opportunity that seems like it's inevitable. And we were all right. I was wrong. I was into it too early. And so I took it on the chin from May of last year until basically April this year. So I was down like 14% in my fund. I got into it after it already got smoked, but it still had another 14% to decline. And so now I'm up in the black. So I haven't made a huge amount of money, but one of my biggest holdings is down in the black from where I was just literally in April. It's way down, like 14, 15% down. Now I'm up probably 5%. So because I'm up 20% since April. So anyway, the point is that people don't wait for the Fed to actually pull the trigger to go into bonds or get away from bonds. The people react according to what they think is going to happen. This is the markets, dude. The markets are 3 to 6 months in advance of what they think is going to happen. They act today in advance of what they think is going to happen. So the market says, we think interest rates are not going to stay high, elevated. We think they're going to go down. We're going to go ahead and buy some stuff today. because we want to be in advance of what the Fed does, and that's what's been happening. It's weird. Like this guy emailed me, he literally thought that when the Fed cut rates, the next day he would be up like 12%. I said, you didn't actually think that, did you? I didn't say that to him. I was thinking that. I was like, yeah, just think if that was the case, how easy? Why would not everybody then pile into the bond market the day before? I was just kind of stunned. I was like, you actually thought that you could buy it on Tuesday and then Wednesday you'd be up 12% just like that because the Fed cut 50 basis points? Now, to his defense, he said his Fidelity guy showed him some charts that showed that. At least this is what the guy says. And I can't speak on behalf of the Fidelity guy or anything like that. They says when the Fed cuts, the bond jumps up. And I said, well, I don't know about that. I haven't looked into it, but I just knew the bond has already jumped up. Anyway, all this has been priced into the bond market. I'm surprised how many people don't get that. I mean, the interest rates that the Fed Reserve controls are the Fed funds rate. That's it. They do not control the intermediate or long-term rates. The market controls that. The market has already indicated that they think the rates are going down because you can see the rates on the 30-year and the 10-year dropping like a brick in water since April. Now, do the Fed control that in some regard by saying we're probably going to cut? Yes, 100%. But they actually don't control the long-term interest rates or the intermediate. They just control the Fed funds rate, which is a proxy essentially, well, not a proxy, which is indicative of what a lot of people say, hey, well, I'm going to get out of the market now before they start raising, or I'm going to get into it before they start cutting. I want to take advantage of either way. And not to know that, to think, well, if I just wait on Tuesday, I buy on Tuesday, then Wednesday when the Fed cuts, I will be up 12%. I'm like, oh my goodness, I don't get where people think this. It's crazy. I've heard this a million times. Why did my bonds go up when the Fed cuts? Because they already went up. It's already happened, man. The bonds have already gone up. The interest rates has already been cut in the bond market. The only thing the Fed controls is the Fed funds rate. They don't control the intermediate and long term. Those intermediate and long term rates have already gone down, i.e. the bond prices already gone up. Anyway, I hope this makes sense. It probably does. I'm just ranting. But I've been getting this email and hearing questions on this. I'm just like, dudes, I can't believe you think it's that easy. I'm just going to hang tight on Tuesday. I'm going to buy it, and Wednesday I'll be up 12%. If it... All right, anyway, God bless. Love your thoughts. We'll see you.